Okay, good afternoon, students. Accounting students. Today I'm going to be talking about Chapter 6, Merchandising Operations. Um, I'm going to focus a little bit on a multi-step income statement. Since last time we talked about classified balance sheet, and so we are in the same category where we have the financial statements in details and categories. Before I go directly to the multi-step income statement, I would like to go through some concepts with you. And as usual, I have the textbook here, and I have my uh, PowerPoints at the same time. So when you see me looking like that or looking like this, and I could be looking either at the book or at the PowerPoints, that just shows you that you really need the textbook in order to function properly. Yeah. Okay. All right. What is a merchandise company as opposed to service companies that we talked about previously? Merchandise company deals with buying and selling goods. Okay, that has merchandise, that has inventory in it. Yeah. Okay, that's the difference. Service company does not have a inventory. Like if there is an accounting firm or a law firm, you won't see inventory there. But for merchandising business, there is inventory. Okay. All right. Um, I want to explain a couple of ideas for merchandising accounting since we're talking about inventory. There are two forms of inventory systems. There is perpetual inventory system and there is periodic inventory system. Perpetual inventory system and periodic inventory system. The perpetual inventory system is, let me close the door. Uh, so, all right, so I won't make any noise for the rest of the house. Yeah. Okay. Going back to inventory, perpetual inventory system is where the business take inventory on a continuous basis. Okay, and that's done in businesses like car dealers. If you notice that they will count their inventory every day almost. Just one item goes out of the parking lot, they know how many pieces left. Or appliances places where they sell refrigerators and uh, washing machines and etc. Or a jewelry store where they sell genuine jewelry, not the fashion jewelry. Yeah. On the other hand, the periodic inventory system, they do inventory um, once in a while, every period, maybe on a monthly basis, maybe every 6 months, maybe where they have thousands of items. That's like a grocery stores, um, like Walmart, Lowe, all of those. Yeah, they use. I'm not sure about Lowe's because Lowe's they have different kinds of inventory. Yeah. Anyway, so that's the difference between these two inventory system. Now I'm going to come to the multi-step income statement. Why is it called the multi-step income statement? If you remember the income statement that we talked about previously in service organizations, um, we just mentioned, okay, we said you list your revenues, and you list your expenses and the difference between them, the summary of revenues and expenses and the difference between them. Now here, before you get to net income, there are several steps that you have to do in a multi-step income statement. And I'm going to show you a multi-step income statement, how it looks like. Um, and I'm going to explain some details for you. This is very important. And I'm using the textbook. And please look at pages 208 and 209. 208 and 209. If you notice the categories, if you look into this format, okay, let me take these out from here. It's too much trouble. Okay. This is a multi-step. Those are the categories of the income statement for merchandising operation. These. You start with your net sales. Okay. You start with your net sales. You have to come up with net sales. Let me see if I can use that specific board that we previously used, and I hope I have my pens. If I don't, I'll just try to say it to you. Okay, let's see. You start with your net sales. Net sales. Okay, net sales. You have to come up with net sales. And it's equal to, net sales equal to gross sales, gross sales minus or less sales returns and allowances, sales returns and allowances minus sales discount. That will give us our net sales. If you notice, you get gross sales minus sales returns and allowances minus sales discount. That give us net sales. Okay. Now, gross sales, if you notice, or if you ever worked in a place, the sales that you have at the end of the day, if you worked as a salesperson or if you worked as a cashier in a grocery store or in a merchandise store, the sales that are done at that day, all what you have in your drawer, that's not what goes to your pocket. Okay, that's your gross sales. What goes to your pocket is, now you may have a sales discount. Okay, once you give the customers discounts, 5%, 10% discount, you take that out of your gross sales, or you may have some returns and allowances. So if some merchandise, once people buy merchandise from you, once they go home and they may find some of that merchandise that you sold them not good or something wrong with it, they will bring it back to you. That's your sales returns. Your allowance, sometimes you may have in the store some items that have a little thing is not right, and so you may go and tell the salesperson, can you give me some allowance on this piece because maybe the pocket is not, or it has some buttons are out. That's a allowance. Yeah. So you take your gross sales minus sales returns and allowances minus sales discount gives you your net sales. Okay, that's your revenues. Okay, that's net sales is the sales that goes to your pockets. All right. From that net sales, we're gonna deduct cost of goods sales, cost of goods sold, sorry, minus net sales minus cost of, that doesn't show, minus cost of goods sold. Okay, you can write it down. Okay, I've got to get me some good ones next time. So net sales minus cost of goods sold. I'll show you in the maybe if I do it this way is going to be a little bit better. Okay, let me try this. Let me try this. Okay, net sales. Hey, that might work. Net sales minus cost of goods sold. Okay, net sales minus cost of goods sold. Okay, net sales minus cost of goods sold equal gross profit. Okay, net sales minus cost of goods sold equal gross profit. Now the thing is cost of goods sold, guys. How do we come up with cost of goods sold? How do we come up with cost of goods sold? Because there is no nice figure just like that you will find. You have to come up with cost of goods sold. So let me show you cost of goods sold on the textbook where it's located. All right. If you look on page 221 of your textbook, you will see a cost of goods sold. You will see cost of goods sold. Okay. You will see cost of goods sold starting from merchandise inventory. This is up to this, I'm going to go through it with you in just a second. These steps give you cost of goods sold. Let me go through that with you. Okay, you start with beginning inventory. Merchandise beginning inventory. How to figure out cost of, how are we going to figure out cost of goods sold? Okay, how are we going to figure out? We start with beginning merchandise inventory. Okay, beginning merchandise inventory. Okay, you start with, let's say that we have $50. We're just doing for explanation. We start with beginning merchandise inventory. Okay, now you're not going to see beginning merchandise inventory. You may say inventory January 1st. Okay, if you have a list of accounts and mixed up, you're going to see merchandise inventory January 1st, and you have merchandise inventory December 31st. So that means that January is your beginning inventory and December is your ending inventory. Okay, so we start with beginning inventory plus you're going to add to that net cost of net purchases. You're going to add cost of net purchases. Net purchases. Okay, so we start with beginning inventory plus net purchases. Now, net purchases, how do we come up with net purchases? How do we come up with net purchases? Okay, net purchases, you're going to start with, like we did with net sales, we also have net purchases. All right. Net purchases starts with your gross purchases. Gross purchases. Okay, you start with gross purchases. You may not know how to read my handwriting, but gross purchases minus or less purchases, returns, and allowances. Okay, gross purchases minus purchase returns and allowances minus purchase discount. Gross, like we did with sales. In fact, these are the flip side of net sales. Okay, net sales from the point of view of the person who's doing the sale, but from the point of view of the person who is buying the merchandise. So you're going to get gross purchases minus purchase returns and allowances minus purchase discount will give us net sales equal, let's say our gross purchases are $20, and then we give $2 returns and allowances and $1 discount. So our net purchases are 20 minus 3, 17. Our net purchases equal to 17. So beginning inventory plus net purchases equal cost of goods available for sale. Okay, cost of goods available for sale. So the 50 plus 17 is equal cost of goods available for sale. Cost of goods available for sale is 60. 50 plus 17 be 67. Okay, 67. Beginning inventory plus net purchases equal cost of goods available for sale. Listen to what I'm saying. Listen carefully. Beginning merchandise inventory plus net purchases equal cost of goods available for sale. But when you how to get your net purchases, like we did with net sales. Okay, your gross purchases minus purchase returns and allowances minus purchase discount give us net purchases. Beginning inventory plus net purchases equal cost of goods available for sale. Now we got to add freight in if we have any. Okay, plus if we have a freight in, before we go to cost of goods available for sale, if we have a freight in, we're going to add, say, plus freight in. Okay, it is part of purchases. Freight in is part of purchases. So beginning gross purchases minus purchase returns and allowances minus purchase discount will give us net purchases. Add to that freight in, that will give us net cost of purchases. Okay, So if we have a freight in, we're going to say net cost of purchases. So beginning inventory plus net cost of purchases equal cost of goods available for sale. From that, okay, let's assume that our freight in is $2. Okay, so net cost of purchases is going to be 20 minus 2 minus 1, so that's 17 plus 2, 19. So we get 19. Gross purchases minus purchase return allowances minus purchase discount, it gives us net purchases. If we have freight in, we add freight in to net purchases, it will give us net cost of purchases. And so we add that to our beginning inventory, it will give us cost of goods available for sale. All right. From cost of goods available for sale, we say less or minus ending merchandise inventory. Ending merchandise inventory, and usually it is given to us. Okay, less ending merchandise inventory. Okay, so cost of goods available for sale minus ending merchandise inventory will give us the magic figure cost of goods sold. Okay, the magic figure. So let's assume that our ending inventory is $30. $30. If ending merchandise inventory is $30, so cost of goods available for sale minus ending inventory, 30. So that will give us cost of goods sold. The magic figure we're looking for is going to be 37. Okay. Cost of goods sold equal 37. 67 minus 30 is 37. Okay. All right. So going back to our first step. Okay. Net sales. Okay. Net sales. Let's assume that our net sales were $100. After we did gross sales minus sales returns and allowances minus sales discount, we got $100. So our net sales are $100. So net sales minus cost of goods sold. Net sales minus cost of goods sold will give us gross profit equal gross profit. Okay, see, this is the profit that still doesn't go to your pocket. Okay, this is the profit that still does not go to your, that's a gross profit. You still have other things to deduct from that. So just remember, net sales minus cost of goods sold will give us gross profit. Now, from this gross profit, we didn't get to net income yet. From this gross profit, we're going to remove operating expenses. Okay, we got to remove operating expenses. Let me go back to the income statement that I was looking at. Operating, from gross profit, we take off operating expenses minus operating expenses. Okay, minus operating expenses. We have two categories of operating expenses. We have general and administrative expenses and sales expenses. Okay, so we have two categories of operating expenses: general and administrative. And the second category is sales expenses. Sales expenses, all that has to do with sales. Okay, sales people, salary, sales commissions, all whatever has to do with sales. Those are sales expenses. Operating expenses like general manager, salaries, depreciation, expense, other expenses, supplies, and all of those that has to do with the operations. Okay. Okay. So once you take these operating expenses, we said we have two categories. You take them off two categories: general and administrative, and selling expenses. Okay, so operating expenses, two categories: general and administrative, and sales expenses. Okay, selling expenses, and that will give us income from operations. All right, that will give us the income from operations equal income from operations. Okay, so net sales minus cost of goods sold give us a gross profit. From gross profit, we take operating expenses out, two categories: general and administrative, and selling expenses. That will give us income from operations. We may have income from other operations. We may have some expenses that has to do with, not to do with operations, our normal daily operations. We may have interest income. If you have accounts, if your business has accounts and it's generating interest from that, you're going to add it after income. If you are paying that interest, that means you minus that expenses. So once you add or minus the other non-operational items, you will get to net income. All right. So this is the details of a multi-step income statement for merchandising operations. Okay. Okay. And if you, I think I went into a little bit more details than the exhibit in the book. So if you look on page 209, your textbook, page 209, it will give you a good category. Okay. On page 209, exhibit 2. That is a multi-step income statement, but it does not have details. See, notice it says, give us net sales though, gross sales minus sales returns and allowances. It looks like they don't have sales discount. That will give them a net sales. And then from net sales minus cost of goods sold equal gross margin or profit. And then you deduct your operating expenses, which are two categories: general and administrative, and deduct those from gross profit or margin. You get income from operations, plus or minus other income, you get your net income. Okay, but it's very important to go through the details that I mentioned. You have to know what do we mean by net sales. You have to know what do we mean by net purchases. Okay. All right. I guess, on the bottom of that exhibit 2, it gives you some details on how to get those specific items. Yeah. Okay, there is a single step income statement where you list all revenues in one category and your expenses in one category and the difference between those. And you can look at exhibit 3. This is a single step income statement. All right. Okay, I am going to talk briefly about some more concepts in the chapter that has to do with merchandising. I'm going to talk about transportation costs. Those are very important components of the merchandising operations. And the merchant, usually before they buy and sell, they have to do negotiations with each other. Who is going to pay for transportation costs? And there are two, once they negotiate, they may settle up on two issues. FOB, shipping point, and FOB, destination. The letter F, okay, for free, O, on board. Free on board, FOB, free on board. FOB means free on board. Shipping point, free on board at shipping point. FOB, destination, free on board at the destination. Okay. Let's say, for example, we are in Tyler, Texas, and if we are getting a shipment of cars from Detroit, okay, if we are getting, let's assume I am a merchant and a car dealer, I want a shipment of cars from Tyler, from Michigan to Tyler. So I would do the negotiations. Now, because this merchandise, it can be part of my inventory, whether it is on the place, on my business place, or not on my business place. Yeah. So we got to determine when do we own that merchandise. The bottom line is you own the merchandise once you get the title for it, once you own the title. Okay, so FOB at shipping point, FOB shipping point, free on board at shipping point. That means the merchandise or the cars are loaded on the truck at the factory in Michigan. At that point, I will bear the costs of the transportation. The title passed to me at the shipping point, and I will bear the cost. No matter what happened in the road, it's my merchandise. Okay, that's FOB shipping point. If we say FOB destination, that means free on board at that destination in Tyler. That means I receive the title of these cars when it gets to the parking lot, my parking lot. At that point, I own the title. That means the seller or the factory has to pay for transportation until it gets to my place. All right, that's FOB destination. All right. Let's see what else what other terms I have to mention. Of course, there are guys, you have to read on your own how to do journal entries for buying and selling. This is very, very important. So that's why I want you to study in details. I want you to study on details, pages 215 through 226. Pages 215 through 226 of your textbook is a must. That shows you the journal entries for buying and selling merchandise. Okay, and there are, like we said, there's one way of doing journal entries under perpetual system, and there are journal entries under periodic inventory system. Okay, we will focus on the periodic inventory system. Okay. I think that's all what I want to talk about in this chapter. Please make sure you know the multi-step income statement. As we said, net sales minus cost of goods sold equal gross profit. From gross profit, you take off your operating expenses. There are two categories: general and administrative, and selling expenses. Once you take those off from gross profit or margin, you get your income from operation. Then you may have income or expense from sources other than operations, other than your normal business. You take those off and from your operating income, and then you will get to your net income. Okay? And those pages I told you about is very, very important to study those. That is the accounting for buying and selling merchandise inventory under the two systems, perpetual and periodic inventory system. Okay? All right. And I think that's all what I have for you regarding chapter 6, merchandising operation. And I hope that I helped you a little bit in that regard, because the classified balance sheet and the multi-step income statement, they both come in the midterm exam. So it's very important that you study those. Those are also one of the chapters that you have to study word by word. All accounting 1 and 2, guys, these are the principles of accounting. Like I said, you got to know the base. That's why there is no study guides. Yeah, you have to read the book in details. Okay, I wish there is any other way, but you have to get the book. I always say to study accounting 1 and 2. Okay, have a good day, everyone, and we'll talk to you later in another recordings.